Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank the Bank, where I try to teach you a little something about finance so you can bank some money down the road. We're looking at investments part 4 now, looking at industries. Please be sure to subscribe or get notifications. Ultimately, there'll be many videos on this site and more related to this topic. Look at the notes and links. We update those after we're done the videos, and then check out the books in our bookstore. There are a couple of cool ones at the end of this lesson. So when you choose industry, we talked about last time, I use a combination of the Mercer paper and Value Line. Like I said, Value Line's got 94, 97, I think it varies through time, but different industries, and they rank them from one to the last. And you do tend to see the ones that are the best, the high end, the top 15, 20 maybe, rotate around to the bottom and vice versa. So I tend to be a bottom feeder on that. I don't want to buy a hot company in a hot industry. But that's one way that I look at possibly choosing industries. Individual securities, kind of depends on the market. I stick to bigger companies in recessions, for sure. I want their cash flow to keep me safe. I prefer profitable and dividend payers. The second best risk return payoff is actually dividend and growth companies, so combination of a 2 or 3% dividend. I can utilize the sector mutual funds or whatever ETFs if I want to. There's a sector mutual funds versus ETFs world out there that is coming soon. So I did pull this up so you could see. We talked about it last time, but I want to actually pull it up for you. This is FinViz, and if you go to the screener up here, you can see it slightly highlighted. This is the first page that will show up. And one thing you can do up here is you can find sectors right here and click on a sector and then look at the industries and decide what you want to do. You can see here, however, there's about, let me draw here, that's always a good thing we can do. You can see there's about 8,400 companies out there, options to invest when it looks worldwide, which is a ton. And I want you to see what that looks like by the time you narrow it down by sector. So consumer defensive, it's a good one to be in now. The market's kind of down and still a possibility of a lingering recession out there. So what makes up the consumer defensive? Well, there it is, kind of like I showed you in Mercer's research on the Excel file I pulled up there. Beverages, alcoholic, non-alcoholic, confectioners, that'd be mine because I love sugar, discount stores, don't know about education training services, or farm products, because I think farmers are going to be stressed by gas prices. But anyway, so you can look at some of these here and figure out that maybe these are industries you might want to click on. But still, the interesting thing to me, we had 8,400 companies. All we did was go to consumer defensive, and now we only have 249. So it's a great way to wean down the list, if you will, from what it is you're looking at. So industries will lead to equity/bond choices. You'll look at different companies in there. And I say bonds because, yes, they're not a bad thing to have depending on the bond markets. But, sometimes you have convertible bonds for a company, another way of getting into a firm and getting a dividend, if you will, along the way. How to analyze those is a separate issue. How to put those together into portfolios is another issue, and it's what's coming next. We're going to roll straight to that presentation. So forming portfolios part 1 begins with knowing your risk and comfort level. We talked about that earlier in the investment side, but you have to know whether you're going to have safe, if you will, or more risky investments. That determines how your risk level, your asset allocation into equities and bonds and so forth. Many other factors do impact along the way, including age and the life cycle. For instance, I have turned most of my human capital into financial capital over my lifetime. I don't want to lose it. So I have a little bit different strategy than maybe you do when you're young, for instance. The economy matters. We do have the money and banking one coming that gets very in-depth about where you find stuff on that. Mutual funds, of course, versus individual securities is another thing you might want to think about. And then factors/anomalies that might actually matter. Get into little factor anomaly stuff. And then finally, what does history or research say? There's Jeff Mercer's paper. Like I said, good place to start. Fed actions matter. You can read the data on several fronts. Look at fundamental analysis to see that. We had a whole series on data and finding data. FinViz and Seeking Alpha are links on Dr. Frank's Finance World. They're probably the best place to go to look at a big picture of what's happening with information out there. What does the data mean? Honestly, you're going to learn through time, but Start now. Learn what you can, because they do tend to repeat again and again. And this is where listening to, Fox Business or CNBC or Bloomberg or whatever, can listen to what they say and how they talk about it, and a lot can be learned from that. But it is, however, an art more than it is a science. Why? Because it's never quite the same from time to time. History does matter, however, and there was a very good article of recession survivors called Lessons from S&P Recession Survivors. And rather than put the PDF, if I can load it up in the comments down, I will below. But I wanted to give you what the outcome of that is. We are worried about recessions from time to time, and is there any place to hide? And they actually look at sort of what people have called the lost decade from 2000 through 2009, and said, what can we learn from that? And here's what they learned. These are what the winners do. It's a tough economy. Top performers had a 426% gain without dividends, while the entire market, the S&P over that time period, lost 35%. So insight number one, your industry bucked trends and your firm learned how to capitalize on this. I guess that's why we kind of like the disruptors, right? You have a strategic advantage, or you created one. Your company did. Love to talk about this in my classes. Why do you own these guys as opposed to somebody else? You sell something everybody needs, a Coke or a computer or whatever. Global demand for energy fueled growth in your industry, because that's going to keep growing and growing and growing it out there. That was a common denominator of the top 20 performers, dealt with that type of stuff. Your firm has the flexibility to ramp up and ramp down in the business cycle. It can be very helpful that firms aren't stuck with too much overhead. 6, though, I thought was one of the more interesting insights. You have a firm that found a niche and ran with it. We used to laugh in the early days. We said, it's that niche. Find out what it is that they have and go after it. Lessons from leading in the next downturn. Know your industry and know where you can exploit opportunity. One of the things I think is interesting in class is I tell people, you work somewhere probably, and you may have more knowledge about what's going on in that industry than others. Exploit it. See how you might figure out a way to make money. Manage forward and predict the actual future, not necessarily the desired future. In other words, be open to what the different possibilities are there. You need a staunch view of reality to be a survivor, whether a disaster victim or a startup or an established business. Know your market and what your customers will be doing 3 to 5 years down the road. Great question down there. I talk to students about that all the time as well. It isn't necessarily what happens in the next 12 months, what happens in the next 5 years that matters. Understand how and that they think that way. Understand how the major global trends may affect all aspects of your supply chain. Sounds familiar recently, doesn't it? Your business, your industry, your employees, your products, your suppliers, and your customers. This is all part of looking at the supply chain and figuring out what's going in and out of there. There's a big global tendency right now to onshore manufacturing rather than an offshore. And I don't think that's going to completely be here. There's going to be other countries like India that probably go to, but the reality is that is going to impact all of this, and who's going to have an advantage in that environment. So business cycles will continue to punish the unprepared. Take time to discern what your firm and you need to do to be successful in light of these powerful external forces. I have a client out of Loveland, love their little business down there. It's not a little bit, it's a pretty good sized business. Just had a meeting with them not so long ago. What amazes me about them is they will look at what's happening next, related or right a part of their industry, and they will flip. They will move whatever direction they have to succeed. And that they are one of the most respected business people that I know because of how they plan that way. All right, diversification. You can get through mutual funds or stocks, depends on how you do it. An advantage of stocks is you can use knowledge best. If you know something that's going on, you can do it with the stock, not just with the mutual fund. You can time your gains and losses. You can sell with capital gains and losses. Mutual funds are going to sell for you. And the worst thing that can happen sometimes is you have a down year, but they sold stocks to give people money back on redemptions, and you end up having a gain and you get a 1099 if it's not tax deferred, and that's kind of a bummer. So more timing of tax gains and losses. Mutual funds, you get the diversification. One company going down isn't going to kill you. You also get professional management and the record keeping. You'll be surprised how helpful that is through time. So this is, or will shortly be, an entire world out there talking about some of this stuff related to the mutual funds versus the stocks and the ETFs. Without specific knowledge, or if you don't have time, and I think this is very, very important, I want to emphasize this, to follow the companies and what's going on, the economy, all the rest, give it up. Just invest in mutual funds, exchange traded funds. It's the best way to go. Mutual funds contain holdings information, can give exposure to certain companies. That you can go find in Yahoo Finance, and we'll go in more detail in that world out there. Put investments into risk categories based on allocation. So that's kind of a strategy we'll get to as well, which is, do you have a barbell strategy? Do you have a hub and spoke strategy? But put them into risk categories and think about that when you're forming portfolios, and make sure that aligns with how you feel about risk and return, your goals, and those type things. So the books, this is a really great one, Managing Corporate Life Cycles. A different name for the guy there, but I've enjoyed reading that quite a bit. And it gives you insight as to how the best companies go about that, and you can look for those companies from an investment standpoint. We've talked a lot about FinViz out there, and Tony Powell has a book on that. That's a link in the bookstore as well. So the best way to utilize what's already there, there's some books on that, and it's really, really helpful. This is kind of an interesting, when you talk about forming portfolios, not really a specific research area or topic. There's gets kind of off the beaten path pretty far, so I didn't pull anything up on that. And all I can tell you is, when you're forming portfolios, my strategy is cast a wide net. Look at stocks, look at some bonds, particularly bonds that can be turned into stocks and so forth. Include individual companies, ETFs, mutual funds. Take a big picture look at it, and then look at what you think could help you most, and how those work together with each other during ups and downs of the economy. So don't forget to send emails with comments. Love it. And ask Dr. Frank. That's something I'm still trying to work on, so we can have a specific category about that and give updates and help you guys understand a little more about some of these topics. So thanks for listening. Have a great day, and we'll catch you later. Bye-bye.